Voice. Welcome back. Silver is under heavy pressure again, and this latest move is getting a lot of attention across the precious metals market. Spot silver, trading under the symbol XAGUSD, opened Wednesday with another sharp decline, falling more than 4% as selling pressure continued to build. This was not just a small pullback or a normal day-to-day move. Silver has now dropped to its weakest level since December 9th, 2025, marking a fresh 6-month low and raising serious questions about whether buyers are still willing to defend this market. For traders, investors, and anyone watching metals as a signal for inflation, liquidity, or economic stress, this decline matters because silver often sits at the crossroads of both precious metals, sentiment, and industrial demand. The scale of the sell-off is what makes this story even more important. Silver is now down more than 50% from its January 29th record high of $121.61 per ounce. That is a major reversal from what had been a strong rally earlier in the year. A drop of that size does not happen quietly. It changes market psychology. It forces short-term traders to rethink their positions, long-term investors to reassess risk, and momentum buyers to step back. When an asset falls by more than half from a recent peak, the conversation shifts from how high can it go to where is the floor? That is exactly where silver appears to be right now, with the market trying to figure out whether this is a deep correction or the start of a longer bearish phase. Silver's weakness is also visible when we look at the more recent move from early June. From its June 2nd high of $76.97 per ounce, silver has now fallen 23.6%. That means the metal has not only given back a large portion of its longer-term gains, but it has also broken down sharply over a much shorter time frame. This kind of fast decline can create nervous trading conditions because it suggests that sellers are still in control and buyers are not stepping in with enough strength to slow the move. For viewers following commodities, this is a reminder that silver can be extremely volatile. It can rally quickly when sentiment is strong, but it can also fall hard when momentum turns against it. The technical picture is also weakening, and that is one reason traders are watching this market so closely. Spot silver is currently trading below its 20-day, 50-day, 100-day, and 200-day moving averages. That is a significant technical signal because moving averages help traders understand the market's trend across different time frames. When a price is below all of these major averages, it usually points to broad weakness rather than a temporary dip. The short-term trend is weak, the medium-term trend is weak, and even the longer-term trend is showing pressure. For technical traders, that kind of setup often confirms that bearish momentum is still active. At the same time, there is another important signal developing. The Relative Strength Index, better known as the RSI, has dropped to 29.31. In technical analysis, an RSI reading below 30 is often considered oversold. That means the selling may have become stretched and the market could be approaching a point where a bounce becomes possible. But oversold does not always mean the price will immediately recover. A market can stay oversold for longer than many traders expect, especially when fear and momentum are driving the move. So while the RSI shows that silver may be nearing extreme downside conditions, it does not guarantee that buyers are ready to take control. That is the key issue right now. Even with silver deeply oversold, buyers have not stepped in with enough force to stabilize the market. Normally, when a major asset falls sharply, bargain hunters may begin looking for entry points. But so far, the response from buyers appears limited. That suggests many traders are still cautious, waiting for stronger evidence that the decline is slowing. They may want to see a clear reversal candle, a move back above a major moving average, stronger volume on a bounce, or some broader improvement in precious metals sentiment. Until those signals appear, the market remains vulnerable to further downside pressure. This move is not happening in isolation either. The broader precious metals complex has also been under pressure, and that matters because silver often moves alongside other metals, especially gold. When the entire precious metals space weakens, it can create a stronger wave of selling because traders reduce exposure across the group instead of focusing on one asset. Silver, however, often moves more aggressively than gold because it has both investment demand and industrial demand. That dual role can make silver attractive during rallies, but it can also make declines sharper when confidence fades. In this case, silver is showing just how quickly sentiment can shift. For investors, the big question is whether this decline is creating opportunity or warning of more trouble ahead. On one side, silver is now far below its recent highs, and oversold technical conditions may attract traders looking for a rebound. On the other side, the trend is clearly negative, and prices remain below all the major moving averages. That combination creates a difficult environment. Buying too early can be risky because falling markets can keep falling. But waiting too long can also mean missing a sharp recovery if buyers suddenly return. This is why many experienced traders focus less on guessing the exact bottom and more on waiting for confirmation. One area that may also see increased attention is silver-related exchange-traded funds. Funds such as SLV, SIVR, AGQ, ZSL, PSLV, SIL, SILJ, and SLVP are connected to silver prices, silver miners, or leveraged and inverse strategies. These products can move sharply when silver becomes volatile. For example, traditional silver ETFs may track the metal more directly, while miner ETFs can react not only to silver prices but also to company-specific risks, production costs, and broader equity market sentiment. Leveraged products can move even faster, increasing both potential gains and potential losses. So for anyone watching silver through ETFs, risk management becomes especially important in this kind of market. The impact on silver mining stocks could also be meaningful. When silver prices fall, mining companies can face pressure because lower metal prices may reduce revenue expectations. Smaller miners can be especially sensitive because they often have less financial flexibility than larger producers. If silver continues to weaken, investors may begin questioning margins, cash flow, and project economics across the mining space. That does not mean every mining stock will react the same way, but it does mean the sector could remain volatile. For traders in miner ETFs like SIL, SILJ, and SLVP, the silver price itself will likely remain one of the biggest drivers of sentiment. Another reason this story matters is that silver is not only a precious metal, it is also widely used in industrial applications, including electronics, solar panels, and other manufacturing-related sectors. Because of that, silver sometimes reflects expectations about economic activity. When silver falls sharply, some investors may interpret it as a signal that industrial demand expectations are weakening. However, price moves are rarely caused by one factor alone. Technical selling, profit-taking, broader commodity weakness, currency moves, and changes in investor risk appetite can all play a role. That is why it is important not to read the silver drop in isolation, but to view it as part of a wider market picture. For short-term traders, the levels to watch now are fairly straightforward. First, traders will be watching whether silver can hold above the new 6-month low area or whether selling pressure pushes it even lower. Second, they will be looking for signs of a technical rebound, especially if the RSI remains in oversold territory. Third, any move back toward the 20-day moving average could become an early test of whether buyers have real strength. But the larger challenge remains the same. Silver needs to show more than just a one-day bounce. It needs follow-through. Without follow-through, rebounds can quickly become selling opportunities in a market that is still trending lower. For longer-term investors, the focus may be different. They may be asking whether the fundamental case for silver has changed or whether this is mainly a technical correction after a major rally. A decline of more than 50% from the record high is severe, but silver has a history of large swings. Long-term investors may look at supply trends, industrial demand, monetary policy expectations, inflation trends, and the US dollar before making decisions. Still, even long-term investors cannot ignore the technical damage. When an asset falls below major moving averages and continues making new lows, patience and discipline become more important than emotion. The emotional side of this market should not be underestimated. When silver was near its record high, the mood was likely very different. Strong rallies often attract headlines, excitement, and aggressive price targets. But after a deep correction, that same market can feel completely different. Fear replaces excitement. Traders who bought near the top may start selling to cut losses. Others may wait on the sidelines because they do not want to catch a falling knife. This shift in psychology is part of what creates momentum. Once sellers gain control, it usually takes a clear catalyst or strong technical reversal to change the direction of the market. So where does this leave silver right now? The current message from the market is still bearish. Prices are at a fresh 6-month low. Silver is down sharply from both its January record high and its June high, and the metal remains below several major moving averages. The RSI shows oversold conditions, which means a short-term rebound is possible, but the lack of strong buying interest suggests traders are not convinced yet. Until silver begins to stabilize and reclaim important technical levels, the near-term trend remains under pressure. That does not mean silver cannot bounce, but it does mean the burden of proof is now on the buyers. For viewers, the main takeaway is simple. Silver is going through a major correction, and the next few sessions could be important. If buyers step in and defend these lower levels, the market may attempt a technical rebound from oversold territory. But if selling pressure continues, silver could remain under stress and force more investors to reduce exposure. Anyone trading silver, silver ETFs, or silver mining stocks should pay close attention to volatility, position sizing, and confirmation signals. This is not a calm market environment. It is a market where momentum is strong, sentiment is fragile, and every key level matters. We will continue watching how silver trades from here and whether buyers finally return with enough strength to change the direction of the trend.